Good morning. Today on TNT we have Will Austin. He is not only our friend but our trusted lender as well. And he's got some cool things that have just been released from Fannie Mae that he's going to talk about, and maybe some bucket list items. So welcome, Will. We're glad to have you today.
Great to be here.
All righty, everybody. Good morning. Good morning. We have Will Austin here with us today.
Good morning.
That's some applause for you. The studio audience was
really
very happy to see you.
I really appreciate it.
They were like, wow, Will's here. It's a good day. So let's start with that. So everybody, it is a marvelous Monday here today. Do you know why it's marvelous today, Will?
I don't. I'm waiting for you to tell me.
It's because you're here, Will.
Oh, thank you.
Yeah, let's go with that. All right, so Will's here.
You just made my week. I really appreciate it.
And we're going to do some, you brought up a good word as you were talking a little bit earlier. You used the word knowledge share. And every once in a while, I like those things when people are able to drop different phrases on us that we think are good enough to pick up and run with.
Okay.
So question number one, Will.
Shoot.
Do you mind if I borrow the phrase knowledge share and implement that?
I think I'm okay with that.
You're okay with that. All right, so we have a win there. So thank you very much for that one, Will. And you had a couple of things that you wanted to start out and teach us and share with us. Your background in the real estate industry, let's start with that.
Yeah, I started in the mortgage business in 2001. I actually started at Beal Bank there on the corner of Legacy and the Tollway.
I know right where that is.
I started by making copies of mortgage documents, both commercial and residential mortgage documents. I knew nothing about mortgage. Mm-hmm. And I was standing in front of my copy machine for 10 hours a day, making copies of documents for loan officers. And that's how I learned the mortgage business, by paying attention to the documents that I was copying.
So did you move up from the fax machine, or is that right where you started?
No, I moved up throughout the company. Yeah.
All right, let's go. Keep telling us. So
then Beal Bank serviced all their loans out to Countrywide.
Okay.
And that was the end of my tenure at Beal Bank. And then I started originating loans. That tenure was about 3.5 to 4 years. Then I started originating loans.
Okay.
And have been originating loans since that point in time. It's about 2004.
That's very good. So I was a former mortgage lender, and I was in the industry for a while, and I got out when things got tough. I had this attitude that, like, well, hey, why would I work harder and make less money than I did? But you stuck through it.
I did. I actually made more money when things got tougher.
Whoa. I like that. That sounds very good to me. I probably should have done that. So let's go ahead and talk about some of the concepts that you have here. You sent over some stuff in advance, and I have some documents pulled up here. Everyone will be able to see these documents that we pull up. I combine this one and the two documents into one. Okay. And I'm going to go ahead and share our screen so they can actively see our screen as well.
Okay.
Just the one right in front of us here. And direct me as to where you would like to start here today.
Let's just start with the Fannie Mae's revised outlook.
You got it.
That came out last Tuesday evening, Wednesday morning.
Okay.
You know, Fannie Mae had provided a revised outlook for the housing market. And in the last paragraph, this is a bunch of economic data. Mm-hmm. But if you scroll down to the last paragraph, this is really what I want to talk about.
Mm-hmm. Let me scroll. Hey, how about you can drive?
All right.
I'll make that easy.
We'll scroll down to the last paragraph.
Mm-hmm.
And this is the impactful data, which is this paragraph right here. Mortgage rates have been declining 6-8 months now. Mm-hmm. The economy is weakening. The global economy is weakening. Our trade battle with China has a significant impact on our mortgage rates. It's unsettling for our investors. So right now, Fannie Mae predicts that mortgage rates by the end of the year are going to be settled at 3.75% for the standard 30-year fixed mortgage. With that decrease in interest rate, their forecast includes that our home price deceleration that's happening right now is going to pause. So we're going to see an increase in price growth. Okay, because interest rates are lower.
Correct.
So that will help the seller's market. We'll have a seller's market again for a short period of time until the economy settles down.
Okay, so let's hit that concept there real quick and explain what that kind of means. Okay, because there's a couple of variables that go into a loan calculator if you're going and putting your numbers in.
Sure.
Right? And essentially what it means in layman's terms, if I'm to use like a simple number, and people are price sensitive, is how much money they put out of their pocket on a monthly basis.
Absolutely.
So if your monthly payment is like, if you're like, hey, I'm comfortable with a $3,000 a month mortgage payment, and interest rates go from 4.5 to 3.75, right? Now, all of a sudden, I'm still comfortable with that same $3,000, but interest rates decreased. I punch in my variables, and the variables in the mortgage calculator, right, are just loan amount. Well, I'd be solving for loan amount in this particular case, but I would have interest rate, I would have term, which is probably going to stay the same at 30 years, and I calculate those numbers in, and all of a sudden I can purchase more when I keep my payment at $3,000.
Correct.
It goes up considerably.
Correct.
And that's kind of the concept here that you're operating under, right? Is that as interest rates go down.
The lower interest rates is going to give you more purchasing power, which is going to drive growth for the overall housing market.
Okay.
Basically what it comes down to.
Yep. So that's amazing, and we're obviously very happy with this. Now, we talk internally about this, that a lot of the interest rate stuff that's going on is not because the Fed lowered interest rates.
Correct.
It's more a factor of yield compression, with the companies making less of a profit as far as the banks go because of competition.
Yeah, so when the Federal Reserve adjusts interest rates, that does not have an immediate impact on mortgage rates. That is a bank-to-bank interest rate. When they adjust the Federal Reserve rate, it's already built into mortgage rates. The market already knows what's coming. So this is the world economy at play, is what really drives interest rates. So the more unsettled the world economy is, the more investors will take their money out of short-term investments and put it in long-term investments, bonds and securities, which drive mortgage rates down. That's good. So it's interesting that poor news for the economy is good news for mortgage rates.
You know, it's kind of a crazy thing. I'm looking at these numbers, and I'm just really shocked. I for a long time I see a number like 3.75. And that's a ridiculous number for an interest rate on a mortgage. Like truly a ridiculous number.
Yeah. It's extremely low. And the average life of any mortgage loan is less than 5 years. So there's not much money to be made for an investor with that interest rate being that low.
Yeah, it's quite a thing. And now, so this does have some long-term ramifications, because as people have lower interest rates, it might be harder later to pull them out of that property and get them to move.
Correct.
So 5 years from now, if interest rates are up at 5.5, and all the people that had a 3.75 interest rate, it's going to take some real motivation.
It does.
To get that person to leave that house.
It does. They have to have a significant reason to leave that house.
Okay.
A life-changing event, most likely.
Yeah. So these are people that are starting to plant some roots. So if you see a number like this and you see our current economy, now is not a bad time for somebody to significantly upsize if they so desired, because they're probably, but I would have said the same thing a year ago, which is crazy.
Sure.
When the numbers were higher, and I was like, holy cow, it was even crazy then.
Yeah, interest rates below 5 are still historically fantastic, below 5%.
So that was some really good mortgage commentary on the whole industry, Will. But let's continue to move on. So we have another document that you had provided us, and I'm going to chat that in so everybody can take a look at this. And this document here, you sent it over and you had two different documents together. Separately, I combined them and put them into one and posted them so people can get to that.
Okay.
So let's go ahead and talk about what you'd like to look at.
Okay.
Give you the mouse.
Well, I wanted to give enough information so that people are educated, but not enough to confuse everybody, because my business is a lot of jargon.
It is.
So this is a basic example of the difference in the past 12 months of interest rates and how much money you can save buyers. So, for instance, a great example, a comparative sample is right now, pretty much every loan officer is on the phone every day calling their previous customers to refinance because the interest rates are lower. So if I compare it to your business, you're having you can call your buyers that were on the fence and say that the $300,000 mortgage is going to save them $155 a month.
Okay.
Or $1,860 a year.
Okay.
So that's the impact of those lower interest
And that's
rates.
Over 1 year, calendar year.
1 calendar year.
Okay.
So that's a pretty big savings.
Yeah.
Each and every month.
Mm-hmm.
You know, that's that can make an impact to your family budget.
Nice. And times 30 years.
Times
right?
30 years is a significant amount of money.
Mm-hmm.
Yep.
Or at the very least, you could do something else. You could help them pay it off faster and take that additional,
Correct. That was my example. You can,
Oh.
you can take that $155 a month and add it to, if you're comfortable with that higher payment, you can take that $155 a month and add it to your monthly payment.
Uh-huh.
One extra payment per year will take your 30-year mortgage down to 23.
Will, I like that we're thinking along the same lines and we're starting to look at some of these things.
Great minds.
That's really good. Well, I don't know. I hope I can have a mind like yours, Will. It's a beautiful thing. So let's take a moment, and I have a question that I like to talk about with regards to mortgages. All right. How about I'll tell you what I think first, and then you can compare and contrast against that and tell me if I'm right or wrong or whatever, right? Because I don't want to be that. So I often like to tell people that I think it's the best idea to go with the consistency of a fixed 30-year rate mortgage. Mm-hmm. And if they want to, they can pay it off earlier by making extra payments and knowing what that is. When somebody's deciding between a 15 and a 30 or a 20 and a 30 or any one of those things, mm-hmm. when you go the shorter term, I feel like you're over obligating yourself mm-hmm. to making that payment. So if you have one bad month, right, and you obligated yourself to this higher payment, and all of a sudden you only want to make this payment for this month, you can't kind of call the bank up and be like, well, but yeah, I'm on a 15-year note, and like, remember, it's kind of cool, I'm like really paying this thing off fast, but this month I only have this much to send you, mm-hmm. which is the amount of the 30-year mortgage. So I often encourage people to go with the 30-year mortgage, calculate what it is, let us tell them the difference. They can send in more to make it perform like a 20 or 15-year mortgage.
Absolutely. This is a great topic because around Christmas time, if you've got kids,
yes,
around summer vacation,
mm-hmm.
that summer vacation is usually more expensive than Christmas. Family trip to the beach or your summer vacation, you're going to need the extra money. Mm-hmm. So having the 30-year fixed option mm-hmm. Is a great option because you can pay down the balance as you see fit.
Will, that was really good. So we're going to definitely hit this button here. Will just dropped a knowledge bomb on us, and he reminded us that the summer vacation is more expensive than Christmas. That's really something.
Yeah. So everybody's scenario is different, and they have to look at it through a different lens. So if you are very comfortable mm-hmm. in your scenario, you don't have many other outstanding debts. Your income is W-2 with, mm-hmm. And your debt to income is at a certain level. A 15-year fix will fit into your budget with no impact. It mm-hmm. makes no impact. But if you've got your scenario is different, the 15-year fix might impact you differently. Mm-hmm. It might fit into your budget, but it only might fit in there 9 months a year. Mm-hmm. So the other 3 months, mm-hmm. Christmas, a couple months in the summer, getting ready for school, it's gonna make it really tight on you and your family. Mm-hmm. And is that worth it mm-hmm. to you and your family? So we have those conversations. Those are good conversations to have.
Nice.
Budget conversations.
All right. Next one you have here is you have a page pulled up for us. Talk about this one here on closing costs.
This is actually one of my favorite topiks.
Oh, this gets you excited.
I like that. Closing costs does, because we get, myself and pretty much every lender that I talk to gets the same conversation. The customer calls because they're looking at things on the internet. The internet does not educate people on the overall process. Okay. So they'll get a call and they'll say, well, what's your down payment requirement? We'll say 3%. And they'll say, perfect, I have 3% in the bank. Okay. And the next question is, how are you going to pay your closing costs? And they're like, mm-hmm. I don't know. So I like to educate people on and educate my partners on the closing costs and the easiest way to explain them. And I explain them as you have 3 buckets of closing costs.
Okay.
Your first.
I only have 2 hands. What am I going to do with the third bucket?
We need some smaller buckets for you.
Oh, okay. So I can carry 2 in one hand.
2 buckets.
All right. Yeah. No problem. All right. So now I handled the buckets.
The first bucket is lender fees. Those are fees that are paid directly to the lender. They're simple processing, underwriting fees. They're to cover the overhead for the lender.
I like how you put that one first.
Well, they're actually the reason I put first. They're the least expensive.
Oh, okay. Process. Good.
Yeah.
All right.
Then the third party fees, which consist of the appraisal, the title work, the homeowners association transfer documents, the attorney doc prep, the survey. They're referred to as pass-through fees, which means when the lender gets the invoice, whatever the invoice is on, whatever the invoice says, that's what the charge is to the buyer at closing.
Mm-hmm.
And then bucket number 3 is your property taxes, homeowners insurance, and prepaid interest. They're a direct result of the price of the home. Mm-hmm. So they're your property taxes, which are determined by the county. Mm-hmm. The buyer chooses their own homeowners insurance, and the prepaid interest is the interest from the closing date until the end of the month.
Mm-hmm. Okay. So those are good things. And you talked about the cash they have to have. So these numbers all play a part in that. And there's another thing that they also have to have, Will, because they have to have reserves so that they can actually afford to pay that afterwards. So you source and season reserves as well.
Correct. Depending on the mortgage program. Some do not require reserves and some do.
Okay.
And depending on their overall scenario, like I said, every scenario is different. Everyone deserves that dedication to their scenario. Mm-hmm. So you can sit down and have a conversation and figure out what works best.
Okay. So just explain the concept of a reserve if somebody's not too sure about it.
Yeah, absolutely. Reserves are the ability to make, to have enough in your bank account to make mortgage payments after closing. Mm-hmm. And some mortgage programs require 2 months of reserves, which is 2 mortgage payments in your bank account or asset after closing. Mm-hmm. Some require 6 months. Some require 12 months. Mm-hmm. Typically, a jumbo mortgage is going to require 12 months of reserves. Mm-hmm. And if you're buying an investment property, you've got to have 6 months of reserves for each property that you own. Mm-hmm. If you own 4 investment properties, that's 6 months for each investment property. Mm-hmm. So the more assets you can show, depending on the property that you're buying, the better off you're going to be.
Because they want you truly to be an investor in that scenario with having capital and invest in the capital and not being a speculator.
They want to make sure you're financially stable for the purchase. Yeah.
Yep, that's good. You know, and with real estate in all these decades that we've been in business now, I've never had a problem with a person when they decided to be a real estate investor and they truly put money into the property in a heavy fashion, like an investor should. That's the term. I have had problems, many problems, when the economy changes or life happens to people, when they become a speculator and they hoped that something would happen. Prices would go up, that vacancy would be 0, that, you know what I mean? Like they go for all these theories and you're just totally speculating. And when you do that, you're setting yourself up for a problem.
Sure. They're interested in rainbows and unicorns.
Yeah.
They like everything to be perfect all the time.
Okay. All right. So that's some really good stuff that you shared with us. You also have a book here. So let's show us the book and tell us.
I bought a book for everybody on your team.
Everybody
on your team. The book is called Make Your Bed.
Okay.
And the reason I bought it is I hand these out to everybody. It's about accomplishing something when first thing you wake up in the morning.
Okay.
So first thing you should do, everybody in your family, including your kids, is make your bed. Because then you've accomplished a goal before you left your bedroom.
That's amazing.
So I am big into these kind of goal-driven books, motivational books.
Nice.
This is a really good one. It's a quick read. It's actually really good for if you've got teenagers.
It's like smaller than your hand. You're like a big man, and it's a small book.
It's really good even if you got teenagers who can read it.
Okay. No, that's actually amazing. Can I share a story with you regarding the bed? Sure. So I have making our bed is kind of a thing for us. So what happens is Sean and I first get married, And I wake up and I'm like, hey, I'm going to make the bed today. So day 1, I make the bed. Day 2, I make the bed. Day 3, day 4, day 5. I make the bed every single day. And then one day I don't make the bed. So then the wife turns to me and she says, hey, how come you didn't make the bed today? And then I realized I had made the bed for all these days consecutively, and I miss it once. And then I have a discussion. In the future, if I changed the way I was doing it, I approached it differently. And I stopped making the bed every day. And I occasionally would make the bed. So I'd make it like twice out of every 7 days instead of like 14 out of 15. And then on those 2 days when I made the bed, she says, hey, thanks for making the bed. And it was really weird that I could go from making the bed twice a week to like almost every single day. And you get a completely different reaction based on what you're doing. So that's my story as it relates to making your bed.
That's a good one.
I don't know if it's good, but it's a story nonetheless. And
You went from doing a chore to getting some encouragement for doing a chore.
I know, it's really, really crazy, right? So anyways, thank you very much for coming in today, Will. I will put these aside for everybody. Please grab them as your agent meetings come along each day this week. I'll have them back here for you. That would be special thanks to Will. Will, are you going to sign the book for him?
No, I don't want to ruin it.
All right. So Will is not going to be signing your book. You didn't write the book, did you, Will?
No.
So why would I even ask if you would do that?
No.
All right.
It's a great book.
All right. Well, thank you very much. Will is, hey, if you're a female agent out there and you didn't know this, Will is at Bro Lunch all the time. And you guys don't know because we kind of do that on our own. And all the women are always like, why do you guys not take us? But I secretly think that they're very happy that we don't invite them because they get to go do different things during that time.
I do.
Yeah. All right. Thank you guys very much. See you next time.